Jim, you'll always come with a new idea. You just presented it to the crowd at SALT, and I would like to get into a little more detail. It is Mallinckrodt and Express Scripts.
Right.
Is this let's be clear, is this a short thesis on both stocks?
It is, and the reason we talked about both companies in my presentation is we think they underscore the problem with pharmaceutical pricing in the United States. And they're both great shorts. Overpricing. And they're both great shorts on their merits fundamentally. But the fact that there's a linkage between the two made it interesting to us. And of course, the geographical location. But,
St. Louis.
St. Louis. But the drug that Mallinckrodt sells that is over 100% of their operating profitability right now is a drug called Acthar, which has been around since 1952. And is really only has efficacious studies for one indication out of the many it gets used for. But the fact of the matter is it's a drug that has gone from $40 to $35,000 over the past 15 years. And that's outrageous in our opinion. And companies like Express Scripts, PBMs, rather than trying to work to eradicate these costs, have actually accelerated them. And that's the issue.
The PBMs, of course, are supposed to negotiate lower drug prices on behalf of their clients.
Right, but in fact, they benefit, the independent ones like Express, they benefit from rising drug prices. And that's the paradox. And we want people to understand.
You believe that PBMs like Express Scripts, independent of this particular example, are guilty of drug price inflation.
And I'm not the only one. Their biggest customer, Anthem, sued them over this issue, saying that they overcharged them for $15 billion.
Jim, you mentioned something in your presentation that is very intriguing. You accuse these two companies of having a Philidor-like relationship. And we remember Philidor as the rock, the iceberg that put a big hole in Valiant's boat.
Yeah. Well, there's three companies that are subsidiaries of Express Scripts that specifically do business with Mallinckrodt's Acthar. United Bioscience, CuraScript, and Accredo. And we go into in our presentation just how these subsidiaries are used to control distribution of this very overpriced drug. And again, in our view, a company like Express Scripts should be working to eradicate the use of expensive drugs with questionable efficacy like Acthar.
So how does this thesis play out? What's the catalyst? Is it a senator in Congress holding a hearing? Is that what it's going to take?
We'd love Senator McCaskill or anybody else to take a look at this.
Or a regulator for that matter.
Because taxpayers are paying for this. And this is now a predominantly taxpayer reimbursed drug in the United States, Acthar. So it's not just the private profit motive. We're all paying for this. And that's the problem. And I think, in an environment where the government can't negotiate drug prices, we're seeing a situation where, in fact, factors are coming to inflate them. And I think that the Acthar Express Scripts linkage is a good place for Congress to start.
Well, the one problem some people may cite is that you're counting on either a politician or a regulator to take action.
Not at all.
Because if that were the case, people could draw parallels to Herbalife, for example.
Sure. And not at all. And in fact, no, because Herbalife isn't being paid for by the taxpayers. It's a private deal. But more importantly, the business at Mallinckrodt has rolled over anyway. And Express Scripts is facing profit pressure anyway. So both of these companies have seen problems well before me highlighting this relationship.
Mallinckrodt's trading at about $41. It's gone down a little bit since you began your presentation. What's it worth?
Well, again, there's $8 billion of debt here. And the operating income over the most recent quarter annualized is under $300 million. So
put a value on it.
Well, I think the debt's not worth 100 cents on the dollar. So what does that tell you about the stock?
Zero.
We think it's a zero.
Really?
Yeah. If Acthar goes the way we think it will, then the stock is worth nothing.
Express Scripts trading slightly less than $60 a share.
Yeah. There it's the business model. And value buyers, stock mavens own this one because it appears cheap. And in fact, it is earning what they say they're earning. But again, we question the business model here. And in an environment where inexorably the public is focusing on costs. And let me just make one point. Years ago, when the ACA was being crafted, Obamacare, I remember speaking to one of the staffers who helped write the bill. And she told me something interesting when I asked, why is there no single payer option? And she said, oh, there will be in 5 to 10 years. And I said, why? She said, oh, because of the way Obamacare has been crafted, everybody is going to be paying higher copays and deductibles than they are now. This was back in 2010. And she says, when the public realizes how much this stuff costs because they start paying for it themselves, there will be single payer. And I've never forgotten that discussion.
I'm not surprised.
And I think actually we may be headed that way.
Speaking of Obamacare, is there a Trump trade for you in the unwind, if you will, of Obamacare?
Well, I think one of the factors that's going to happen if the ACA is repealed, along the lines of the current House bill, which will be watered down, I suspect, in the Senate, is there's a whole raft of companies that are providing what's called essential health benefits. Things
Hospitals?
like, well, more like psychiatric,
Okay.
Drug addiction centers. All these things were mandated to be in everybody's policies, and they're now looking to water that down as a major attempt of cost savings. A number of these companies saw their profits explode from 2010, 11 on. Those companies will be in a lot of deep trouble.
Can we name some
In
of them?
addition, some of the leveraged hospital companies, which we'll see a return to people using services and not being able to pay for them. So bad debt expense is going to go up, like the bad old days. And I'm not going to name them, but if you do, your viewers do their own work, they can figure out who they are.
What about, there are a couple of other things that I see out there that make me think they might interest a short seller like you. Subprime auto loans.
Yep.
Banks are getting worried about subprime auto loans. We saw that, in the first quarter.
Yeah, and there's increasing evidence now that consumers are stretching, and even like the bad old days of liar loans, mortgage loans, are beginning to lie about their income things to qualify for auto loans. But on top of that, used car prices have now begun to decline rather precipitously, which has a real impact on lots of things in the auto chain.
Sure.
Residual values on leases, and then the value of stuff on the lot.
So you buy that thesis?
I do buy that thesis.
And
I think the autos have basically have seen their peak for the cycle. 8 years.
How do you express it?
Well, there's a number of companies. I mean, you could look at a company like CarMax, which has one-stop shopping, if you will, which is a used car and also provides financing for its customers. Because in many cases, the finance arms are separate. You have companies like Ali Financial or Santander that do auto loans. They trade at low multiples, as they should. But if you look at a company like CarMax, it trades at a very high multiple relative to both standalone auto dealers and standalone finance companies.
Are you short CarMax?
We, let's just say we're a potential purchaser, Erik. How's that?
Potential purchaser?
Yeah.
I see. To close out your short position. What about retail?
Retail, we're only in a few outlets and not as big as we should have been, I guess, is the best way to put it. But there are
Hang on a second. Not as big as you should have been.
Yeah.
You didn't see the collapse of traditional retail coming?
Well, we did, but
you guys do a lot of hard work. I've seen it.
We do, and unfortunately, we weren't as short as we should have been. That happens. But we have a few. There's a few as well that have had a new lease on life, where the stocks are hitting new highs that are every bit as impacted by the online phenomenon. I'm not. I can't talk about those names yet. Not prepared. But we're redoubling our efforts. Let's just say that.
You're redoubling your efforts in retail. But how much? Let's forget for a moment those stocks that are hitting new highs.
Yep.
Of the retailers that have already taken a drubbing.
Yep.
Is it too late for you?
We've covered some of them. So I mean, again, we have to make judgments on the portfolio at all times. And some of them do have value. I mean, the very best retailers that you could have been short, the negative rebates on them were prohibitive, Erik, in that although the stocks went down, you were paying 20-30% a year for the pleasure of borrowing them, something like Sears. I mean, it was obvious what was going to happen there 5 years ago. And yet,
which is obvious being what? What's going to happen?
that the stock price was going to go down. They would get in financial trouble. But yet the negative rebate was anywhere from 20 to 40% per year. And so you don't see that when people analyze just the stock price declines. But in my world, you also have to factor in,
of course, the cost of your
a
short
borrow.
position. Sure.
If there's a negative borrow, yeah.
Is Sears going bankrupt?
I don't know, but I'm just saying that it didn't matter because we never really could affect the trade from our perspective.
I find it curious that, I mean, it doesn't sound like you missed the retail trade, but I find it curious that you weren't.
The ones that are most troubled were the ones that I described that had this negative rebate phenomenon. So others saw it 3-4 years ago as well, and the demand to short the stock. And remember, it's not always short sellers. It could be trade creditors or bondholders who are shorting the stock to hedge their exposure.
What about retailers that don't suffer from some of the problems, say that Sears does, or J. Crew does, or Route 21? These are highly leveraged companies.
Yep.
There are some other retailers that are clearly having some issues, like Macy's, which are relatively unlevered.
Yep. And so there you have to analyze things like the real estate and there's a lot of other levers, financial engineering levers that management can use. Also companies that have benefited from competitors going out of business, which have given their business a temporary boost, which may be subject to the same long-term digital disruption that the other companies are. So it's a mixed bag. It's a big area. But again, the ones that we thought were most attractive, unfortunately, were not really actionable.
Jim, you've never been short of words on Tesla. Tesla's trading at $312 today.
Yeah, God bless them.
What's it worth?
I don't think the equity's worth a whole lot. I mean, we were short Solar City, and we thought that was heading to bankruptcy, and they bought it out. And now the CEO is quietly, resigning, Musk's relative, and their installations were down big, so they took that off the market's hands. Look, Tesla will be dependent on the Model 3, and that all of the other nonsense notwithstanding, that at the end of the day, the company is not worth what it is trading at today on its current business. And if you don't believe me, just look at what Elon Musk was quoted in the papers today as saying. He himself said the stock is not worth $50 billion.
Well, I think he said the market was being generous.
I think actually, if you read it,
he said a little bit more.
He said a little bit more. He pled poverty. It was a response to worker safety issues. But it's a very eye-opening quote. And so at the end of the day, they must succeed in making a mass production car, the Model 3.
Right. And if the Model 3 is successful, Tesla's no longer a short?
Well, I mean, Tesla has a market cap now greater than the U.S. market, the U.S. auto OEMs, and it's moving in on BMW's market cap. BMW this year will do 100,000 hybrid and EV vehicles, the same as Tesla. I mean, think about that for a second. So,
and they still have the rest of their business.
And they have the rest of the businesses too. So, this is really, to me, one of the poster boys for this market, because a lot of the valuation of a Tesla is based on the come. It's based on all the stuff that will happen between 2020 and 2025 that people get excited about. And in an environment where people expand their horizons, you can get a valuation like this. But in an environment where people get scared or the capital needs overwhelm the company's ability to raise them, something else happens.
Conviction level as high as it's ever been or not?
Oh, I love the short. It's great.
And one last question before we run out of time. Last year when you were here, Jim, we talked about Lending Club having been a successful short for you.
Yep.
Sun Edison having been a successful short for you. What's been successful recently?
Well, some of the specialty drug areas that we mentioned in the we were short Valiant, but it doubled on us first from early 14 on, and we've had some success in some other areas that we haven't talked about publicly.
This is your opportunity.
It's okay, but in any case, the opportunity set in the U.S. in particular is expanding, and we're finding a lot to do here. And previously we had been in Asia and other places, but right now the
not
U.S.
so short China anymore.
We're not as short as we were, but we're still way overweight, and that's not any call on China being any less of a disaster. It is, but we're actually seeing really interesting, actionable one-off ideas in the U.S., and we'd always rather do those given the chance.